Warren Buffett is worth over $100 billion. He's one of the richest people in the world. He's considered the greatest investor who has ever lived, but he didn't inherit wealth. He didn't invent a revolutionary technology. He didn't start a billion-dollar company from nothing. He did something far more accessible. He learned how to invest. He applied simple principles consistently for decades, and compound interest turned modest beginnings into one of the largest fortunes in history. Today I'm going to show you how Warren Buffett built his wealth. Not the mythology, the actual strategy, the specific decisions, the principles you can apply. Let's start at the beginning. Warren Buffett was born in 1930 in Omaha, Nebraska during the Great Depression. His father was a stockbroker who later became a congressman. The family was middle class, not wealthy. Warren showed an interest in money and business from an early age. At 6 years old, he bought 6 packs of Coca-Cola from his grandfather's grocery store for 25 cents and sold individual bottles for 5 cents each. Small profit, but he understood the concept. At 11, he bought his first stock. City's Service Preferred at $38 per share. He bought 3 shares for himself and 3 for his sister. The stock dropped to $27. Warren was worried but held on. Eventually it recovered to $40 and he sold. Then he watched it go to $200. This taught him 2 lessons he never forgot. First, don't panic when stocks drop. Second, don't sell good investments too early. By age 13, he was delivering newspapers and making money from multiple sources. He filed his first tax return at 14, claiming his bicycle as a work expense. Here's what matters about these early years. Warren wasn't just earning money. He was saving almost everything. While other kids spent their earnings, Warren saved and invested. By high school, he had accumulated several $1,000s, which was significant money in the 1940s. At 16, he had about $5,000 saved. He used some of it to buy 40 acres of farmland in Nebraska, which he rented out to farmers. But the real transformation came when he went to Columbia Business School and met Benjamin Graham. Benjamin Graham is known as the father of value investing. He wrote 2 books that changed Warren's life: Security Analysis and The Intelligent Investor. Graham taught that stocks aren't just pieces of paper you trade, they're ownership in real businesses. And sometimes, the market prices those businesses far below what they're actually worth. Graham's approach was mathematical and conservative. Find companies trading for less than their liquidation value. Buy them cheap. Wait for the market to recognize their value. Sell at a profit. Warren absorbed this completely. He became Graham's student, then worked for him at his investment firm in New York. But Warren eventually modified Graham's approach in a crucial way. Graham focused on buying cheap companies even if they were mediocre businesses. Warren learned to focus on buying great businesses at fair prices. This shift, influenced by his partner Charlie Munger, became the foundation of Buffett's success. Now let's talk about how Warren actually built his fortune. In 1956, at age 25, Warren returned to Omaha and started his first investment partnership with family and friends. He raised $105,000, of which $100 was his own money. The partnership structure was simple. Investors got 6% per year, or 75% of profits above 6%, whichever was higher. Warren got 25% of profits above 6%. If returns were below 6%, Warren got nothing and had to make up the shortfall later. This structure aligned his interest with investors. He only made money when they made money, and he was risking his reputation with family and friends. From 1957 to 1969, the Buffett partnership returned an average of 29.5% per year. The S&P 500 returned about 7.4% over the same period. $100 invested with Buffett in 1957 became over $2,000 by 1969. $100 in the S&P 500 became about $240. How did he do it? By following Graham's value investing principles with discipline. He looked for companies trading significantly below intrinsic value. He bought when others were fearful. He held cash when everything seemed overpriced. He didn't follow trends or speculation. During this period, Warren made some of his most famous investments. He bought significant stakes in American Express during a scandal when the stock crashed. He bought Disney when it was undervalued. He accumulated Berkshire Hathaway shares, which we'll come back to. By 1969, Warren was wealthy. The partnership was worth about $100 million, of which his share was about $25 million. He was 39 years old. Then he did something shocking. He closed the partnership. He told investors the market was overvalued and he couldn't find good investments at reasonable prices. He returned their money. Most of it went into municipal bonds or a textile company he controlled called Berkshire Hathaway. This was 1969. The market peaked in 1972 and then crashed. By 1974, stocks were down 50%. Warren's decision to close the partnership and move to cash looked prescient. Now let's talk about Berkshire Hathaway because this is where the fortune was really built. Berkshire Hathaway was originally a failing textile company. Warren had been buying shares cheaply. Eventually, he took control. The textile business was struggling, but it generated cash. Warren used that cash to buy other businesses and invest in stocks. This became his model. Use Berkshire as a holding company. Buy great businesses outright when possible. Invest in stocks of great businesses when buying the whole company isn't feasible. Hold forever. Some of Berkshire's most important acquisitions and investments include See's Candies, bought in 1972 for $25 million. A beloved California chocolate company with strong pricing power. This taught Warren the value of brand and customer loyalty. See's has generated over $2 billion in pre-tax earnings for Berkshire since purchase. GEICO, the insurance company. Berkshire bought its first stake in the 1970s and eventually bought the whole company in 1996. Insurance became one of Berkshire's most important businesses because insurance companies collect premiums up front and pay claims later. The money in between can be invested. This is called float, and Berkshire has used it brilliantly. Coca-Cola. In 1988, Berkshire began buying Coca-Cola stock heavily. The total investment was about $1.3 billion. Today, that stake is worth over $20 billion. This investment exemplifies Warren's approach. A simple business with a durable competitive advantage, global reach, and brand power. American Express, Washington Post, Wells Fargo, Apple. The list goes on. Each investment shared common characteristics: strong competitive advantages, good management, understandable business models, reasonable prices. The key to Berkshire's growth wasn't just buying great businesses. It was keeping them, letting them compound, and reinvesting their earnings into more great businesses. Berkshire Hathaway stock has grown from about $15 per share in 1965 to over $600,000 per share today. That's a compound annual growth rate of about 20% over nearly 60 years. If you had invested $10,000 in Berkshire in 1965, it would be worth about $400 million today. Now let's talk about Warren's investment philosophy because this is what made the returns possible. Principle 1. Invest in businesses you understand. Warren avoids technology stocks for most of his career because he doesn't understand them. He invests in insurance, candy, furniture, banks, railroads, businesses with simple models he can evaluate. Only later does he invest in Apple after understanding its ecosystem and competitive advantages. Principle 2. Look for durable competitive advantages. Warren calls these moats. What protects this business from competition? Is it brand power like Coca-Cola, network effects, cost advantages, switching costs? Without a moat, competitors erode profits. Principle 3. Focus on the business, not the stock price. Warren evaluates companies based on their fundamentals: earnings, cash flow, return on equity, competitive position. He doesn't care about short-term price movements. Principle 4. Be patient. Warren's holding period for his best investments is forever. He bought Coca-Cola in 1988 and still owns it. He's held American Express for decades. This patience allows compound interest to work its magic. Principle 5. Be greedy when others are fearful. Warren's best investments often come during market crashes when everyone else is panicking. He bought during the 1970s bear market after the 2008 financial crisis, during the 2020 COVID crash. When quality businesses are on sale, he buys. Principle 6. Don't lose money. This is Warren's first rule. The second rule is don't forget the first rule. He avoids speculation, excessive debt, and situations where he could suffer permanent loss of capital. These principles are simple but difficult to follow. They require patience, discipline, and emotional control. Now let's address some myths about Warren Buffett. Myth 1. He got rich from trading stocks. False. Warren doesn't trade. He invests for years or decades. His wealth comes from compound interest on long-term holdings, not from buying and selling frequently. Myth 2. He knows something you don't. False. Warren's investments are public. His strategy is public. He writes annual letters explaining his thinking. The information is available. What's rare is the discipline to follow the strategy consistently. Myth 3. You need to start young to achieve what he did. Partially false. Warren did start young, which gave compound interest more time to work. But his investment principles work at any age. Starting at 40 is better than never starting. Myth 4. His success was luck. False. 60 years of market-beating returns isn't luck. It's skill plus discipline plus time. Here's what actually made Warren Buffett successful. First, he learned correct principles early. Value investing, long-term thinking, focus on business quality. He built his entire approach on solid foundations. Second, he applied those principles with extreme discipline. He doesn't chase fads. He doesn't panic. He doesn't deviate from his strategy. Third, he benefits from compound interest over an extraordinarily long time horizon. He started investing at age 11. He's 94 and still investing. That's 83 years of compounding. Fourth, he structured his life to maximize learning and decision quality. He reads constantly. He thinks deeply. He avoids complexity. He says no to almost everything except what matters. Fifth, he lived frugally and reinvested everything. He still lives in the house he bought in 1958 for $31,500. He doesn't spend on luxury. Every dollar saved was a dollar that could compound. Let's talk numbers. How did $100 become $100 billion? Warren's net worth in 1956, when he started his partnership, was about $140,000. His share of the partnership by 1969 was about $25 million. That's from age 25 to 39, 14 years, $140,000 to $25 million. His stake in Berkshire Hathaway continued growing as Berkshire's value increased. By 1990, he was worth about $3.3 billion. By 2000, about $30 billion. By 2010, about $47 billion. Today, over $100 billion. The growth accelerated over time because that's how compound interest works. The first million is the hardest. The first billion takes decades. But once you have billions compounding, each year's growth can be billions. 99% of Warren's wealth was accumulated after his 50th birthday. Not because he suddenly got better at investing, because compound interest needs time to show its full power. Here's the practical lesson. You're not going to replicate Warren's fortune. Starting conditions, time horizon, and skill level matter. But you can replicate his approach. Invest in quality businesses. Hold for decades. Let compound interest work. If you invest $10,000 today in an S&P 500 index fund and it grows at 10% per year, in 30 years you'll have $174,000. In 40 years, $452,000. In 50 years, $1.2 million. That's compound interest. It doesn't make you a billionaire, but it changes your financial life. Warren's 3 key quotes that summarize everything. Quote 1, the stock market is a device for transferring money from the impatient to the patient. Quote 2, rule number 1, never lose money. Rule number 2, never forget rule number 1. Quote 3, someone is sitting in the shade today because someone planted a tree a long time ago. Patience, risk management, long-term thinking. That's the message. Here's what I want you to understand. Warren Buffett's success isn't about being smarter than everyone else. It's about being more disciplined, more patient, more focused on principles rather than short-term results. You don't need to pick individual stocks. Index funds are perfectly fine, but apply Warren's principles, invest regularly, hold through market crashes, don't panic sell, don't chase trends, think in decades, not months. The power of compound interest is available to everyone. You just need time and consistency. Warren started with almost nothing, $100, a paper route, small investments, but he saved everything, invested everything, and let time do the work. 60 plus years later, $100 billion. You won't become a billionaire. But if you follow the same principles on a smaller scale, you can build significant wealth, not through speculation, not through luck, through patient, disciplined, long-term investing. That's the real lesson of Warren Buffett. Not that he's a genius. That compound interest works. That patience wins. That simple principles, consistently applied, produce extraordinary results. Thanks for watching.